Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our partners at Strategas. Today, we're lucky enough to be joined by Managing Director and Head of Fixed Income Research, Tom Tzitzouris. Tom, how are you doing this morning?
I'm doing great. How about yourself, Ross?
Doing excellent. Thank you for asking. I want to talk about rates. That's where the action has been in the bond market. There's been a lot of volatility, and I think we have to start with the fact that even though there was an initial flight to safety amid some of the turmoil in the Middle East and downward pressure on yields, it really didn't stick. And this upward surge in yields that we've seen over the last 2 to 3 months has kind of continued despite the turmoil. So I wonder what you make of that and what it means for your rate outlook, maybe looking out 6 to 12 months.
Well, yeah, that's absolutely right. So as of this morning, we're looking at 10-year Treasury yields that are now at about 4.9% or a little bit higher than that. And that's interesting because if you were to go back, we'll say 16 years, the last time we were at these levels was August of 2007, as then new Fed Chair Ben Bernanke was indicating that we were not about to enter into a whole new regime. And that's interesting because obviously we have completely retraced over the last 16 years that regime of low interest rates and low inflation. And we are now at the point where we stood at the precipice of the crisis in 2007. So this is just one amazing reversal of yields, and technicals seem to indicate that we could continue rising from this point. 490 on 10s is still below what you might expect if the market anticipated long-run nominal growth to be 5% or greater over the intermediate term. So there's nothing that says we can't rise another 10 basis points, 15 basis points, 25 basis points. And what's more, if economic data were to continue to come in strong, like earlier this week we saw retail sales coming in strong, last week we saw inflation, both CPI and PPI coming in strong. If that data continues to come in strong, then the ceiling continues to rise on 10-year Treasury yields. On top of that, for the bond bears out there, we're still looking at Treasury supply continuing to be very difficult to digest with demand evaporating and the Fed reducing its balance sheet. So big picture here, if we don't have a recession in the next 3-6 months, then very likely we're going to breach that 5% ceiling on 10s and keep rising.
So the Fed and a lot of the Fed speakers have been out lately saying that this move in long-term yields, it doesn't replace a rate hike, but it does enough to tighten financial conditions such that they may not have to hike again in November or December as they previously expected. So you have this broader tightening of financial conditions. What do you think it means for the Fed ultimately, and does it change how you think about what they might do over the next couple of months? And then does that impact your economic outlook if the Fed is done hiking?
Well, I think it's important to distinguish between whether I agree with the Fed, what they're saying there, and whether I think they're going to do something different. I don't agree with the statement, and we have seen many at the Fed who've said that increasing 5, 7, 10-year Treasury yields don't substitute for increases in the Fed funds rate. I would completely disagree with that, but nonetheless, that is how the majority at the Fed seem to think at this point in time. So that suggests to us that what we're seeing with this rise in longer-term bond yields is probably itself not going to completely stop the Fed from raising rates again, but it certainly will make them pause and think about it. But I do think it's important to distinguish between increases because the bond market is tightening financial conditions and increases in interest rates because when the Fed raises rates, it disproportionately impacts Main Street USA, small businesses and households. When the bond market tightens financial conditions, it disproportionately affects risk assets, non-risk assets, and large companies alike, as well as the U.S. government and states and local governments. So it's a different source in a different direction of the tightening. And that's, I think, what the Fed needs to distinguish here. It's not really about substitutability or lack thereof. It's that you're just tightening on different entities. With that said, the bond market is tightening financial conditions, as you just suggested, and that is going to disproportionately, at this point in time, affect larger companies and governments. So it'll be interesting to see how the Fed responds, because once the tightening begins to affect governments, that's when you start to get political pressure pushing back on the Fed policy. So we'll see what the Fed does. But right now, I think the best course of action for the Fed, Jerome Powell and the rest of the Fed, is to pause and evaluate and see what the new data coming out in the next few weeks suggests.
Right. They've hammered that data-driven or data-dependent approach, and I think we'll see from here. One final question. You mentioned that long yields could have some upside to go from here, especially if the economy remains somewhat strong into year end. Are you still thinking or considering adding to duration, to long-term bonds in your asset allocation portfolio with the view that while it may be choppy in the near term, yields will ultimately reverse as the economy slows in 2024?
Yep, we're always looking to add at this point in the business cycle because I continue to say the next 100 basis point move in 10-year yields is more likely to be lower rather than higher. And we do expect there to be a recession sometime before the end of next year, but we keep pushing that back. So at this point in time, we're not interested in making any sort of tactical duration trades because simply put, we're very likely to continue to push higher in yields in the very near term. But from a strategic standpoint, and especially for income-driven investors, we love the value here on long duration treasuries. We do think that investors are eventually going to be rewarded with price appreciation, and the income now at a 490 on 10s is getting much closer to what you're getting in the cash market, with downside protection too if interest rates drop. So we like this for income-driven investors, and from a strategic long-term buying perspective, we like an entry here. We're just not ready to do a tactical duration increase at this point in time because the technical suggests we're going to push above 5% in the not too distant future.
That makes a ton of sense. Well, Tom, thank you so much for the time as always. Appreciate the insights and hopefully get to talk to you again soon.
Thank you.